You know what is absolutely insane? While the entire world was obsessing over Bitcoin hitting new highs and technology stocks defying gravity, silver just pulled off a move that has not happened in over 40 years. I am talking about a market shift so violent and so unexpected that it caught every major global bank completely unprepared. And here is the kicker: this might just be the beginning. Let me paint a picture for you based on the data we are seeing right now. Imagine it is May of 2025. Silver is trading around $30 an ounce. Nothing special, right? But fast forward to October, and suddenly we are looking at $59. That is not a typo, $59. We are talking about a metal that spent the better part of 2 decades being the most boring investment on the planet, suddenly doubling in less than 6 months. Now, I have been analysing precious metals and global finance for years. I can tell you with absolute certainty that what we are witnessing in the structural data right now is not normal. This is not your typical commodity rally. This is something different, something much bigger. And the scary part is that most people still have no idea it is happening. Let me throw some numbers at you that will blow your mind. If silver starts the year around $28 an ounce and touches $59.20 by late October, do the math with me here. That is a 111% gain in less than 10 months. When was the last time you saw returns like that on a tangible asset that has been money for 5,000 years? But here is what really gets me excited and, honestly, a little bit terrified. This move is designed to catch everyone off guard. And I mean everyone. The big banks, the hedge funds, and the so-called experts on television who spend all day telling you what to think. None of them are positioned for this. In fact, the data shows they are all positioned the wrong way. They are betting against silver big time. You see, there is a mechanism called the COMEX. It is basically where all the big institutional players trade silver futures. And for years, there has been a persistent reality that the silver market is heavily managed. The theory is that big banks have been artificially keeping the price down by selling massive amounts of paper silver. This is silver that does not actually exist in physical form. It is just contracts, promises, and IOUs. Now, I am not here to tell you conspiracy theories. I am here to look at the hard data. Something in the market structure is breaking. It is like a dam finally cracking after years of pressure building up behind it. And when that dam breaks, the water comes rushing through faster than anyone expects. We are looking at a historic event. A wealth transfer that only happens once or twice in a generation. The technical term for what the charts are predicting is a short squeeze. But that phrase does not really capture the magnitude of what is happening here. To understand this, we need to look at the mechanics of the trade. Imagine you borrowed your neighbour's car and sold it, thinking you could buy it back cheaper later. You pocket the cash and wait for the price to drop. Except the price of that car suddenly doubles and your neighbour wants their car back immediately. Now that is basically what has happened to these bullion banks, except we are talking about billions of dollars worth of silver. Here is where it gets really interesting from a financial perspective. The physical silver market is tiny compared to the paper market. We are talking about a market where the actual physical metal that exists is dwarfed by the number of contracts claiming to represent that metal. Some credible estimates put it at 100 ounces of paper silver for every 1 single ounce of physical metal available for delivery. Think about that ratio, 100 to 1. Can you imagine what happens when people start demanding physical delivery? When industrial users, investors, and even smart institutional players stop trusting the paper contract and rush to get their hands on actual physical silver. That is exactly the scenario we are seeing unfold. Industrial giants are waking up, China has been quietly stockpiling, India's demand has gone through the roof. Even the solar industry is entering a state of panic because they need silver for solar panels, and suddenly there is not enough to go around. The supply chains are stretching to their breaking point. The premiums for physical metal over paper prices are exploding. This is what we call stage 5 panic. And gentlemen, we are living through the setup for it right now. Now, before we dive deeper into what is causing all this chaos and where silver might be headed next, I need you to understand something crucial. What we are witnessing is not just about making money. This is about a fundamental shift in how the global financial system works. Let us look at the crime scene behind the curtain. The COMEX is supposed to be where silver price discovery happens. It is meant to be a fair market where buyers and sellers come together. But here is the dirty little secret that nobody in the mainstream financial media wants to talk about. It has been a paper market for decades. In January of 2025, the total open interest in silver futures on the COMEX represented over 1 billion ounces of silver. That is 1 billion with a B. Now, how much silver do you think actually exists in COMEX warehouses available for delivery? At the start of the year, we are talking about roughly 300 million ounces. See the problem. There are more than 3 times as many claims on silver as there is actual silver to deliver, and that is the conservative estimate. For years this worked fine because most traders never actually take physical delivery. They are just speculating on price movements. They buy a contract, they sell a contract, they make or lose money, and they move on. The silver itself never moves. It is all just accounting entries on a computer screen. But the data changed this year. Starting around March, we began seeing something unusual. The amount of silver leaving COMEX warehouses started accelerating, not by a little bit. We are talking about double-digit percentages month after month. By summer, the eligible silver stocks, which is the silver actually available for delivery, had dropped below 200 million ounces. These are the lowest levels we have seen in years. This is the nightmare scenario for anyone holding a short position. Once you get below a certain threshold, once the ratio of paper claims to physical metal gets too extreme, the whole system becomes incredibly fragile. It is like playing Jenga. You can pull out a lot of blocks and the tower stays standing. But eventually you pull out one too many and the whole thing comes crashing down. That is exactly the structural setup for a price explosion to $59. The banks and hedge funds that had been shorting silver, betting the price would go down, suddenly find themselves trapped. The price is going up, not down. And to make matters worse, people are actually demanding physical delivery. They want the real metal, not just paper promises. Let me tell you about something that most silver investors completely overlook, and it is actually one of the most compelling reasons why this rally has legs. We need to talk about the industrial demand side of the equation. Because what is happening in the real economy with actual silver consumption is absolutely mind-blowing. Silver has always had industrial uses, but what is happening now is different. We are in the middle of multiple technological revolutions that all happen to be incredibly silver-intensive. Let us start with solar power. A typical solar panel uses about 20 grams of silver. That might not sound like much until you realize that the world installed over 400 gigawatts of solar capacity in 2024 alone. And those installation rates are accelerating. The solar industry consumed roughly 160 million ounces of silver in 2024. That is roughly 15% of total annual silver production globally. And here is the kicker. Solar installation rates are projected to keep growing for at least the next decade. Countries around the world have made commitments to green energy that require massive increases in solar capacity. Even if we just maintain current installation rates, we are talking about a steady demand of over 100 million ounces per year just from this one sector. But it gets better. Electric vehicles use significantly more silver than traditional cars. We are talking about 30 to 50 grams of silver per electric vehicle compared to 15 to 20 grams in a conventional combustion engine car. And electric vehicle sales are exploding globally. In 2024, over 10 million electric vehicles were sold worldwide. If that number doubles by 2026, which many analysts expect, we are talking about an additional 50 to 70 million ounces of annual silver demand just from the automotive sector. Then you have 5G infrastructure. Every 5G base station requires significantly more silver than previous generation cellular equipment. With carriers rolling out 5G networks globally, we are adding millions of new base stations that all need silver for their circuits and connections. This is demand that did not exist 5 years ago and keeps growing exponentially. Now here is where the math gets really interesting. Total annual silver production from mining is around 850 million ounces. Add in recycling and you get maybe another 150 million ounces. So we are looking at a total supply of around 1 billion ounces per year. But when you add up industrial demand, jewelry demand, investment demand and other uses, we are consuming basically all of that production plus eating into above ground inventories. And unlike gold, where most of the gold ever mined still exists in vaults and jewelry, silver gets consumed. It gets used up in industrial applications where it is not economical to recover it. We are talking about billions of ounces of silver that have been essentially lost to industrial consumption over the past few decades. Silver cutlery melted down when silver was cheap. Silver in old electronics that never got recycled. The supply-demand deficit that has been building in the silver market is real, and it is structural. We are not talking about a temporary imbalance that will correct itself. We are talking about a situation where annual consumption exceeds annual production, and that gap is widening. Now, here is where we need to zoom out and look at the bigger picture, because what is happening with silver is not happening in a vacuum. There is a perfect storm of macroeconomic factors converging right now that are setting the stage for something even bigger than what we have already seen. Let us talk about the Federal Reserve. Throughout 2024 and into early 2025, the Fed had been holding interest rates at elevated levels, trying to keep inflation under control. But by the spring of 2025, the cracks in the economy were starting to show. Regional banks were struggling, commercial real estate was imploding, the job market was softening, and suddenly the Fed found itself in a corner. In June 2025, the Fed finally blinked. They cut rates by a quarter point, then another quarter point in September, and here is what most people do not understand. When interest rates go down, the opportunity cost of holding precious metals goes down. Think about it. If you can get 5% in a savings account, holding silver that pays no interest seems less attractive. But when interest rates drop to 3% or 2% or lower, suddenly that silver looks pretty good. But it is not just about interest rates. It is about what those rate cuts signal. When the Fed cuts rates, they are essentially admitting that the economy is weaker than they have been letting on. They are admitting that they are more concerned about recession than inflation. And historically, what happens to precious metals during economic uncertainty? They go up. Way up. Here is another piece of the puzzle that is absolutely critical. Inflation. Real inflation, not the fake numbers the government publishes. Anyone who has been to a grocery store or paid rent or bought a car in the last few years knows that the cost of living has gone through the roof. And silver, like gold, is one of the oldest inflation hedges in human history. It is real money. It has been money for thousands of years. And when people lose faith in paper currency, they turn to real assets. The dollar has been losing purchasing power steadily, and everyone can feel it. But here is the thing. Silver has been playing catch-up for years. Gold has been hitting new all-time highs, while silver lagged behind. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, got stretched to ridiculous levels. At one point, we were looking at ratios of 80-1 or even higher. Historically, that ratio averages around 60-1. Throughout much of history, it was closer to 15-1. So when silver finally started moving, it had a lot of catching up to do. And that is exactly what we have been seeing. As silver doubled from $30 to $60, the gold-to-silver ratio compressed dramatically. We went from ratios in the 80s down to the 50s, and many analysts, myself included, think there is still a lot more compression to come. Now, when we start talking about where silver could go from here, we need to look at historical precedents. The most obvious comparison is to 1980, when silver briefly touched $50 an ounce during the famous Hunt Brothers events. But here is the thing. If you adjust that $50 price from 1980 for inflation to today's dollars, we are talking about $180 or more. So even at $59 or $60, we are nowhere near the inflation-adjusted all-time high. We are still cheap by historical standards. Let us be conservative, though. Let us not assume we are going back to inflation-adjusted highs immediately. Let us just look at realistic near-term targets based on current market dynamics. The technical resistance levels above $60 are clear. The next major target is $70. That is not a random number. It corresponds to several different technical indicators and prior resistance levels. Here is my base case scenario. If the Fed continues cutting rates through 2025 and into 2026, which seems likely given the economic data we are seeing, that is going to put continued downward pressure on real interest rates. Lower real rates are rocket fuel for precious metals. Add in continued physical demand from the solar and electric vehicle sectors, plus ongoing supply constraints and the technical momentum we have already established. Based on this model, hitting $70 by the first quarter of 2026 is not just possible, it is probable. But let us talk about the upside scenario, because this is where things get really interesting. If we see a genuine crisis in the banking system, if we see a real loss of confidence in fiat currencies, if we see the COMEX inventory situation deteriorate further to the point where they literally cannot meet delivery obligations, well, in that scenario, all bets are off. We could see silver go to $100 or more in a very short period of time. I am not saying that is my base case. I am not trying to pump up some ridiculous price prediction. But I am saying that the risk is asymmetric here. The downside risk is probably back to $50 if we get some kind of major correction. But the upside risk could be multiples from here. That is what makes this opportunity so compelling from a risk and reward perspective. The technical chart pattern is undeniable. For years, silver was stuck in a range between $20 and $30. It would test the upper end and get smacked back down. So, we have talked about what is happening and why it is happening. Now, let us talk about the practical side. What can you actually do about it? Because understanding the silver story is one thing, but positioning yourself to potentially benefit from it is something else entirely. First and foremost, let us be crystal clear about something. When I talk about buying silver, I am talking about physical silver, real metal that you can hold in your hand. Not silver ETFs, not mining stocks, and definitely not futures contracts. Those all have their place for traders. But if you are trying to protect yourself from monetary chaos and participate in this historic move, you want physical metal. Here is why physical matters so much. Remember that disconnect we talked about between paper and physical silver? That premium you have to pay over spot to get actual metal exists because real silver is harder to get than paper promises. In a crisis scenario, that premium can explode. We have seen times in history when physical silver commanded 20 or 30 or even 50% premiums over the paper price because you just could not get it. When you own physical silver, you own an asset that cannot be printed by a central bank. It cannot be debased, it cannot be inflated away. It is real money that has been recognized as valuable for thousands of years across every civilization. It is the ultimate insurance policy against financial system instability. One strategy that makes a lot of sense right now is dollar cost averaging. Instead of trying to time the market perfectly and buying everything at once, consider setting up a regular purchase schedule. Maybe you buy a certain dollar amount of silver every month, regardless of price. This way, you average into your position over time and do not stress about short-term volatility. Now, I want to be completely transparent about something. I am not a financial advisor. I cannot tell you specifically what to do with your money. Everything I have shared here is educational information and my personal analysis of the silver market based on historical data. You need to do your own research and make your own decisions based on your situation. But I will tell you this. The setup we are looking at right now in silver is one of the most compelling I have seen in decades. The combination of technical momentum, fundamental supply and demand dynamics, macroeconomic tailwinds, and physical market tightness creates a situation with enormous potential. And the best part is we are still early. Most people have no idea this is happening. The banks certainly did not see it coming. They got caught on the wrong side of this trade and they are still trying to figure out how to extract themselves. But you do not have to make their mistakes. You can position yourself on the right side of history. The window of opportunity is open, but it will not stay open forever. The question is, will you take action or will you look back a year from now wishing you had paid attention to the signs?